we have been discussing a continuation of the uptrend. Last week, we only have spike of the volume here and also here. Two sessions came with a spike of the volume. First one on Monday, second on Friday. But there's a demand tail show up. Here is another demand tail show up. The supply level has been decreasing. Jim say, please include your opinion of the S&P Golden Cross. Sure, let me turn on 50 and 200 MA. Here is a golden cross. Here is the cross to the downside. Here's a cross to the upside. The blue line is the 50-day MA, and the red line is the 200-day moving average. We have the two cross here. Here is the golden cross that Jim was talking about on the 1st of July. Subsequently, we see a pause of the uptrend. Take a look at the death cross where the 50 MA dropped below the 200-day moving average. By the time you see this kind of a cross here, for example, we already have the structure breakdown. We have a breakdown, a retest, and also acceleration to the downside. If you're paying attention to this kind of a cross, 11th of April, that's right after the bottom form on 7th of April. This sort of a cross is late. However, look at this 200-day MA has been acted as a supporting MA. Here, almost touching. Here is a breakdown. Once it's got a breakdown, come back, have a retest. The 200-day moving average acted as the resistance level, show some rejection, and then sell off. The 200-day moving average can be considered as a reliable support MA. Here is another good one. Once we have a bottom form on the 7th of April, we have a test and then a rally. Once we have a breakout above this 200-day MA, we have a quick test. Here is a quick test. We're using this 200-day MA as a support and then bounce back. I would consider a 200-day moving average as a more useful MA rather than looking at the cross. In short, I don't consider the golden cross or the death cross as a useful indicator because they are a lagging indicator, but rather if you overlay the SMA, for example, it could be 200, it could be 150, it could be 50 or even 20 or 10. As long as the price respect the MA, then we can continue to use that. Back in 2022, we have a bear market. This is a top information. We have a distribution here. And the first breakdown came in January. This is an obvious sell, but the death cross came somewhere around here. Here is the death cross in March. It is very late. By the time we have the golden cross, here is the golden cross. This is the choppy. We are still stuck within the consolidation. Here's the golden cross. And after the golden cross, it still bounce up and down for another 4 months until the breakout. We need to use MA with the trading context. Look at the price structure. For example, here is a trading range. When the 50-day MA is still below the 200-day MA, while this is a consolidation or the sideways market, it simply means that this is not a trending market. Until we see a breakout back in June 2023, this is where we want to participate. If we take a look at the individual stock setup, some of the stocks could have broken up, have the breakout while the index is consolidating. Some of the individual setup already outperforms. These are the stocks that we want to trade. In short, I don't consider the cross that much because they are lagging indicator. But if you look at the 200-day MA in general, that will be quite useful. Once we have a break and then attempt to rally, and it treat this 200-day MA as a resistance level and then followed by a sell-off here, you could consider this as a downtrend until a breakout happen above this 200-day MA, followed by another test, act as a support. Here is also a valid structure. Once we have a breakout above the prior swing high level and then act as a access line, flipping zone, and then continue to the uptrend. This as a shallow consolidation, not even a pullback. Supply level has been decreasing throughout. Even last week, we only Monday bar and also the Friday bar came with localized increase of the supply. The bearish results is limited because we have a demand tail. It suggests a continuation to the upside. We could still have a push to the upside until some form of a spike of the supply like this or even this. At the moment, we could conclude that both the supply and demand have been decreasing. Watch out for the exhaustion of the demand. When the demand is too tired, exhausted, people want to take profit, it could have a spike of the supply, localized increase of the supply with a big bearish bar. That's a ease of movement to the downside. That's where we need to be careful because that could mark the start of the pullback or a correction. Having said that, even if we get a pullback 6150 to 6100 is the first immediate support zone without violating the uptrend. We could have a push and then sell off, pullback, some consolidation that is still looking constructive, bullish, and is likely going to break above and to test higher targets. Looks like a flag, a higher low structure pending a breakout. Look at the supply level. This is relatively low supply level, means that the supply is still held tight by the smart money. The only thing I want to pay attention to is a spike of the supply with bearish results. Until then, we're still up and there are plenty of the bullish setup